too many people take a point of view which is too simplistic. Most people want to hear me say in or out, buy or sell. It's not that easy, and it's never black and white. Every investor, at virtually every moment, should, to some extent, be afraid of being in the market and of the potential for losing money, and should, to some extent, be afraid of being out of the market and missing opportunities. And how you balance those two uncertainties is really the key. The balance we strike between the fear of losing money and the fear of missing opportunity should change over time based on where the market is in its cycle. When the economy's been doing well, as it has, the companies have been doing well, as they have, the psychology is positive, as it has been. The stock prices have been rising, getting everybody very excited, and the prices are high by most objective measures. That is the time when you shouldn't worry that much about missing opportunity, and you should worry more about losing money. And when we're high in the cycle, it's time to be defensive, in my opinion. So it's a relative thing. It's a rolling adjustment that you should make. Obviously, the higher the market goes in its cycle, the higher prices go, I would think the less you would want to have invested. But that's just me. The booms that I've seen, there have been common threads, primarily too much optimism, too little risk aversion, too much money in the hands of people who are too eager to put it to work. And if you think further, it would be hard to imagine having a boom with those ingredients missing. Also remember that our asset classes are risky asset classes. We're not investing in S&P stocks, mainstream stocks. We're not investing in high-grade bonds. We invest in high-yield bonds, convertibles, leveraged loans, distressed debt, real estate, infrastructure, some private equities, emerging markets, Japan. Most of the things we do are risk markets. And we're not risk avoiders, but I hope we're intelligent risk bearers who are highly conscious of risk, operating in risky markets. But we are more cautious than usual today, you're right about that, because we think the market is elevated in its cycle, and because we think there has been optimism, risk tolerance, and money eager to get to work. The central banks and the Fed turned their attention to stimulating the economy, and they engaged in massive rate cutting, and interest rates went to zero, negative in some places, and we had massive stimulation in the form of quantitative easing, which meant the central banks buying securities, which has the effect of, number one, raising their price and reassuring people about risk, and number two, putting money in circulation. Because when the central bank buys securities, it pays for them with money, and that money, when it circulates in the economy, lifts the economy. So in the last 10 years, we've had an unusual emphasis on stimulation of the economy, but that it brings risks as well, because it brings the risk of the economy overheating and thus of hyperinflation. It's a complex dance that the central banks have to perform. I don't describe what we're having now as a bubble. People have gotten used to the concept of bubble and crash. Bubble and crash. It happens that if you live through the last 20 years, the last two cyclical episodes were bubble and crash. We had the internet tech bubble, which crashed. We had the subprime mortgage bubble, which crashed. That doesn't mean that every upswing becomes a bubble, which is an extreme upswing, and crashes. And I don't think that this upswing has been as dramatic as those two, and I don't think the correction has to be as dramatic as those two. That doesn't mean it's going to be fun, because in those two, I'm going to, roughly speaking, say stocks went down 50-odd%. Maybe in the next one, they'll only go down 30%. Doesn't mean it's going to be fun. But I don't think that we are as levered as a society today. I don't think our essential financial institutions are as levered. I don't think that we have anything in the mix which is as, shall I say, fraudulent as subprime mortgages. And as a consequence, I don't think we are riding for a bubble of the severity of the last one. I am for more fiscal responsibility than is being shown at the present time. I am opposed to running large deficits in good times to stimulate an economy that does not need stimulation, and adding so radically to the debt as is being done at the present time. And yet, I can't tell you where the debt reaches critical mass and what the impact is. That'll be a matter of destructive testing. We'll find out the answer when these things bind, and unfortunately, when, as and if, it'll be unpleasant.